Hello everyone. Almost every single Federal Reserve officials has recently expressed the idea that Federal Reserve shouldn't be cutting interest rates anytime soon, advocating for a higher for longer stance, citing concerns about hot inflation and hot economy. But what they're actually focused on in their speech is the short-term interest rate, which is the Fed funds rate. That's currently at 5.25 to 5.5%. But the way Federal Reserve actually manipulates long-term interest rates, such as 10 to 30 years Treasury bond yield, is by manipulating its balance sheet. And this is what this video will be focused on. Because when Federal Reserve reduces balance sheet by running off the mature bonds and not renewing them fully, that effectively decrease the demand for those treasury bonds in the market. For example, if $100 worth of treasury bond matures this month, if Federal Reserve only buys back, let's say $95 of it, $5 will disappear from Federal Reserve's balance sheet. When there's less buying pressure for bonds in the market, the bond price will drop. As a result, the bond yield will go up. And when long-term interest rate or bond yield goes up, it affects borrowing costs for long-term debts, such as mortgage, car loans, or even long-term debts borrowed by businesses. In the May FOMC meeting, Federal Reserve has clarified officially when and how it's going to slow its QT. It's going to start the QT reduction in June, and the balance sheet runoff amount will decrease from $95 billion a month to $60 billion a month. If we look at the current Federal Reserve balance sheet, it has decreased from the peak of $9 trillion in June 2022 to $7.35 trillion today. Why is Federal Reserve slowing its QT pace? I think the reason is simple. Right before the May 1st FOMC meeting, we just saw another regional bank failure in the end of April, and I made a video about it on my channel. The regional bank was called Republic First Bank. Federal Reserve worries that this is the beginning of another wave of regional bank failure, just like what happened in March 2023. That was led by the collapse of Silicon Valley Bank, and then we saw Signature Bank, and then we saw First Republic Bank bankrupt. If another big wave of regional bank failure happens this year, it would definitely tighten financial conditions. It can disrupt local economy by other regional banks being protective and constraining their credit lines and financial services, which will cause financial instability. And the Federal Reserve should do whatever they can to protect financial stability. And besides the fear of more regional bank failure, there is also the fear of liquidity crisis. This has happened in 2019. So 2019 is when the last QT took place, and the Fed drained so much liquidity out of the system in 2019, it caused a near freeze up in an important area of money market, which is the U.S. overnight repo facility. The overnight repo rate in 2019 was at 1 point, jumped to 10%. After the 2019 liquidity crisis, Federal Reserve actually introduced a new tool called Standing Repo Facility, or SRF. This is designed to provide financial institutions with the ability to borrow overnight funds directly from the Federal Reserve against high-quality collaterals to prevent what happened in 2019. Right? In 2019, the liquidity issue was so bad, banks won't even borrow to other banks, even if you pay 10% interest. Right? So that's where this SRF will come into place if what happened in 2019 happens again. But the problem is, in theory, on paper, this new tool is going to work. but it's yet to be tested because since 2019, we have never had the similar issue happen again. And it also reminds me of what Warren Buffett said in the annual meeting happened a month ago, that the next recession or the economic crisis is going to look different than what happened before. Like, it's going to look different in 2018-19. It's going to look different than the 2008 financial crisis. So maybe it's going to be something different, or a different set of challenges that's going to break the US financial system. Now, as a conclusion, I think changing the monthly QT amount from $95 billion to $60 billion is definitely a dovish movement of the Federal Reserve. It's crucial, but it's very crucial to recognize that it's still a form of tightening, even though it's only at $60 billion a month, because the Fed is still shrinking its massive balance sheet. It's just being done at a slower pace. So this will continue to exert upward pressure on the long-term interest rates, like the long-term treasury yields. So currently, with the inflation being at around 3.5% year-over-year CPI, I think it's currently significantly lower than the Fed funds rate of about 5.25 to 5.5% range. So I think the reduction of the QT pace is the correct move, but I think it needs to continue to be reduced towards zero, because I believe that's where the neutral policy is for balance sheet, where the balance sheet stays put. Right? It doesn't increase, it doesn't shrink. That's where the neutral point is. When that point, and that's going to match their policy on the short-term interest rate. Right? They're pausing the Fed funds rate, so they should also pause the balance sheet, because once they pause the balance sheet, that's going to help Federal Reserve to balance between their dual mandates, which is inflation fighting, and also they have to ensure that the economy in the US is stable. Okay, thank you very much. Please subscribe to my channel. Bye.